Corporate finance practice problem using Excel. Warrant versus stock price percent increase. Get ready, it's time to take our chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we're in the practice tab as opposed to the example tab. The example tab, in essence, being an answer key. We have the information on the left-hand side. We're going to populate that information into the blue area on the right-hand side, looking at our warrant, considering what would happen if there was an increase in the underlying stock price to the percent change in the warrant versus the percent change in the increase in the stock price. So we've got the warrant to buy 1 share of common stock. So the warrant allows us to buy 1 share of common stock. The cost of the warrant is $7. The exercise price, meaning if we were to exercise the warrant for the 1 share of the common stock, would be $18. The stock market price, meaning the stock is currently selling for $22. So if we had the warrant and we can exercise it, then we would be getting it for $18 versus the $22, but we got to pay $7 currently to get the warrant. And then we have to assume the changes. We're going to assume changes that take place in the future, meaning the stock price is going to go up to $31 and the warrant sells at its theoretical value. So we're not going to have any premium at that point in time, which we'll take a look at shortly. So given those circumstances, we want to calculate the percent increase in the stock price and the warrant price. So there's that increase in the stock, and we want to look at that percentage change. What we expect to happen is the warrant, because it's kind of a leveraged item, then it's going to have a greater increase, we suspect, with the percentage increase. So let's check it out. So we got the stock market price. Let's take a look at the intrinsic value. It's going to be comparing the original stock market price at the $22 versus the exercise price, how much we can buy the stock for if we had the warrant and exercised it. And that would give us the intrinsic value equal to 22 minus 18. So if we had the warrant, font group, underline, and exercised it, we can basically get a discount of that $4 if we were to exercise it at that point. But we got to pay $7 for the warrant if we bought it at this time. So the price of the warrant is $7. So it would cost us $7 in order to get the intrinsic value if we were to exercise it at this point in time, which we're not required to, but if we did, we'd have a benefit of the $4. So that means we got this premium, the speculative premium of 7 minus 4 or 2, or 3. So it would be $3 off if we were to just buy the warrant and exercise it at this point in time, as opposed to simply buying the stock, if that's what we want to do. But we might want to hold on to the warrant, is the thing. So in any case, let's say the stock price goes up. What would be the increase in the stock price if we bought the stock and it went up? What would be the increase or the percent change in the stock price? So we're going to say the new stock price is now, we're saying $31 versus the starting stock price, which we said was $22. That's a change or increase of 31 minus 22, so it went up by $9. Let's underline the 22 here. And so we're going to compare that to the starting stock price of $22 to get the percentage increase. Font group, underline, percentage increase, percent increase, stock price is going to be equal to 9 over 22. So we had an increase of, making that a percent, number group, percentifying it, add a couple decimals, the 40.91% increase in the stock price. What would happen to the warrant if we were holding on to the warrant? We didn't exercise it or anything, but we're just holding on to it. And we bought it, if it was $7, now it went up. Well, now we got the new stock price. The new stock price, let's do the same. New stock price is now at the $31 versus the exercise price of the warrant, which is at $18 that we can exercise the warrant for. Underlining that, we're going to go to the font group and underline. That's going to give us our intrinsic value. Intrinsic value is going to be equal to the 31 minus 8. So it went up by 13 on the intrinsic value, meaning if we had the warrant at this point in time, we could basically exercise it for $18, and the stock price is at 31, so we'd have a benefit of the $13 for the new And that's also going to be, we said down here, notice it said down here that there's no speculative premium. So when we had the warrants before, the speculative premium may go down basically as time passes. And so we had a speculative premium before here, meaning that the cost of the warrant, you could see, of course, was higher than simply the intrinsic value. Now we're saying it's not higher, so we're going to say that the intrinsic value represents or is the same as the warrant price. So we're going to say this is the new warrant price, which is simply going to be that $13. So if that's the case, then what's the percentage increase in the warrant price? If we were to hold on to the warrant, we're going to say now the new warrant price is now $13. The starting price, the starting warrant price, let's say make it a capital, starting warrant price was $7. Let's pick it up right there. So there's a change, font group underline. We got that change, which is going to be equal to 13 minus 7 is going to be a $6 change. That's going to be the increase. The increase was $6. And if I compare that to the starting price, which was 7, we get the percentage increase. Let's make that an underline, font group, and underline. We're going to say this is going to be the percent increase in warrant price, which is equal to the 6 divided by the 7. Percentifying that number group, percentify, add a couple decimals. We're at, wait, hold on a second, couple decimals, there we go, 85.71. So if we think about this, of course, this increase had a change here on the intrinsic value. The intrinsic value, 13 minus 4, which is $9, and that's the same as the change we had down here, of course, in the stock price, changed by that $9. But the change in the actual price is not exactly the same because of the speculative premium, which we had a speculative premium before of the $3 because the price was 7 versus the intrinsic value of 4. We would expect possibly that premium to go down over time. So we're saying there is no speculative premium. That's why here we've got the 13 minus at the price minus the 7 results in a $6 change as opposed to the $9 change, in essence, the stock price. So notice you have, in that case then, because of that, you actually have a lesser amount of a change in the warrant versus the change that we had basically in the stock price. Stock price changed or went up by $9 because of that speculative premium difference. We've got this increasing on the warrant by $6. But if you compare that to the starting price, then you get the kind of leveraging effect where you have a percentage increase over here on the warrant side of the 85.71 percentage increase versus the percentage increase on the stock, which is only 40.91%. So in other words, we can state it this way: movement in the stock price causes the warrant to rise on a smaller initial investment. The initial investment is smaller due to it basically being a leverage kind of concept. So the percent gain in the larger is larger for the warrant than it is for the stock, even though the dollar increase was higher for the stock than the warrant.